Have you ever just watched your mortgage rate, or the one you're hoping to get, and wondered, why is it changing? It can feel totally random, but I promise you, it's not. Turns out, about every 6 weeks, this small, really powerful group gets together in Washington, D.C., and what they decide can directly hit your wallet. So, okay, let's jump right in and decode the Federal Reserve.
All right, so who exactly is pulling the strings on what is probably the biggest loan of your life? I can tell you it's not your friendly neighborhood bank, and it's definitely not the politicians you see arguing on TV. The real answer? Well, it might actually surprise you.
It all comes down to this group right here, the Federal Open Market Committee. You'll hear people call it the FOMC for short. They're basically the ones in charge of monetary policy for the U.S. Federal Reserve, and believe me, figuring out what they do is the absolute key to understanding your mortgage.
Now, to get why they make the decisions they do, you first have to understand their mission. The FOMC isn't just in a room throwing darts at a board to pick interest rates. Nope. They're operating under a very specific set of instructions handed down to them from Congress.
And that mission is called the dual mandate. You can think of it like a constant, high-stakes balancing act. On one side, they have to create economic conditions where as many people as possible can find jobs. That's maximum employment. But on the other side, they have to keep prices stable. And that's really just a fancy way of saying they need to keep inflation in check. Every single decision they make is an attempt to keep these two big goals in perfect harmony.
So how do they actually do it? Well, their number one tool in the toolbox is this thing, the federal funds rate. I know it sounds super complicated, but just think of it as the special interest rate for banks. It's the rate they charge each other for loans they make overnight. And by tweaking this one single rate, the Fed kicks off a chain reaction that ripples through the entire economy.
And this, right here, is probably the most important part of this whole explainer. How a decision made in a boardroom in D.C. makes its way all the way down to the interest rate you get offered for a home loan.
It's basically a three-step ripple effect. First, the FOMC announces a change. Let's say they decide to raise their target rate just a tiny quarter of a percentage point to fight off inflation. Boom! That immediately makes it more expensive for banks to borrow money. And, just like any other business, when a bank's costs go up, they pass those costs right on to you, the customer. All of a sudden, that tiny 0.25% hike could mean your mortgage offer jumps from 6.5% to 6.75%. And that could add hundreds of dollars to your monthly payment. That's the ripple effect, right there in your bank account.
Okay, now here's a really crucial little detail. While the Fed's rate has a big influence on all kinds of loans, those really long-term loans like a 30-year mortgage, they have a more specific dance partner, the 10-year Treasury yield. Why? Because the yield on this government bond is kind of seen as the benchmark for long-term risk in the economy. Investors and mortgage lenders watch it like a hawk. The Fed's actions have a huge impact on this yield, but it's not a direct one-for-one connection.
And this visualizes that relationship perfectly. Just look at how the bar for the 30-year mortgage rate basically moves in lockstep with the 10-year Treasury. When the yield on that 10-year bond goes up, you can bet mortgage rates are almost always going to follow. When it drops, mortgage rates tend to fall right along with it. So the Fed's decisions and, just as importantly, their language, create the market's expectations that move this Treasury yield. And that, in turn, sets the whole stage for your mortgage rate.
Okay, so if what the Fed does is so incredibly important, how can you and I get ahead of it? How do you even begin to predict what they might do next? Well, it's not about having a crystal ball. It's really about just knowing where to look for the clues. You see, after every single meeting, the Fed gives us two incredibly powerful tools that basically act as a roadmap for their thinking. And if you know how to read them, you can get a surprisingly clear idea of where interest rates are probably headed.
So tool number one is something called the dot plot. What's great here is this chart simplifies the whole idea. Basically, every member of the committee anonymously puts a dot on a chart showing where they think the federal funds rate should be in the coming years. So for instance, on this simplified version, you can see the committee's average projection for this year is 4.5%. They see it dropping to 3.8% next year and eventually selling around 2.5% in the long run. By looking at this, we get this amazing snapshot of what the committee is thinking about the future path of interest rates.
But, as revealing as that dot plot is, the second tool is often even more important. It's the press conference that the Fed chair holds right after the announcement. This is where the market hangs on every single word to figure out what's really going on.
And this is the absolute key takeaway. You have to listen to the language. When the chair starts using phrases like inflationary pressures or talks about a tightening labor market, those are massive signals. Honestly, the tone of voice and the specific words they choose can send mortgage rates flying up or down, sometimes more than the actual rate decision itself. All right, let's bring all of this home. Let's talk about how this all builds to something you can actually use. Because understanding all this complex stuff, it isn't just for a grade. It's a real, practical tool you can use for your own financial life.
To put it simply, being able to decode what the Fed is saying gives you a huge advantage. It doesn't matter if you're looking to buy your first home or maybe refinance your current one, this knowledge helps you make sense of why rates are moving and gives you an educated guess about where they might go next.
So here's your action plan. First, find the 8 annual FOMC meeting dates and put them on your calendar. When the day arrives, listen to that press conference for those key phrases we talked about, words about inflation and employment. And just keep reminding yourself that every single one of those words can translate directly into the future cost of borrowing money. Being informed isn't just about being smart. It could literally save you tens of thousands of dollars over the life of your loan.
So there you have it. You now have the tools to decode the Fed. You understand their big two jobs, you get the chain reaction, and you know the key signals to watch for. So the only question left is, based on everything you're seeing in the economy today, what do you think the Fed is going to do next?